From the morning reading, depending on the rules, stocks recently suffered a Dow theory sell signal. The industrial, utilities, and transportation averages all set 52-week lows within a couple weeks of each other. During the past 40 years, in particular, this has proved to be a better buy than sell signal. Despite losing more than 4% for the week ending Thursday, the EEM Emerging Markets ETF saw more than $1 billion in inflows. That's more than 4% of total assets. In that fund's history, it has dropped 4% in a week, while assets expanded more than 4% only two other times, 2004 and 2008. EEM rallied in the shorter term both times, then struggled. It's impossible to include anything from that. There's not enough events. But very generally, it is not a positive sign to see inflows as a fund declines. Hello, this is Stephen Harris, the head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:55 a.m. Central Time, and I'm recording this in preparation for the market day of September the 24th, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's dive into the morning report. See what we have with our overnight. And what we do have with the U.S. broad market indices is universal weakness. And indeed, at the time of this cut, the S&P was down about 0.9%. The Russell was down about 0.75%. NASDAQ down the most at over 1%. And the Dow almost 1%. And take a quick glance over here. We are currently on the ES down about a 9.9%, about 16 points, so about the same as when that was cut. In terms of crude oil, we are up about 0.3%. Euros up about the same. Bonds up about 0.5%, and gold up about 0.33%. Pretty mixed action overseas. The China market up about 0.9%, Hong Kong down about 1%, Japan down about 2.76%, so pretty steep decline in Japan. Germany, though, as we roll over to Europe, Germany down almost 2%, United Kingdom down about 0.2%. In terms of U.S. macroeconomic reports for today, you have core durable goods, and the weekly version of the unemployment claims report, and new home sales. That's during market hours, and if you're a natural gas trader in that futures market, you have your natural gas storage report today. After the market closes, you had Fed Chair Yellen speaking, so that could play into the overnight action. And then on Friday, we have a couple yellow flag reports. One orange flag report, the University of Michigan Consumer Sentiment Report, and that will come out during market hours. In terms of current volatility conditions, there was no standard deviation moves put in yesterday, and it was a kind of multicultural holiday, most notably the Yom Kippur, the most important holiday, I understand, for the Jewish faith. So volume yesterday, bottom line, was about half of the average, and indeed, took a look at volume in the last 4 weeks, and it was basically tied with the lowest volume day for the last month. So we'll probably learn a lot more today when all the market participants are back and we see perhaps more normal volume. But in terms of the last 2 trading weeks, actually probably just a little bit below average in terms of the number of standard deviation moves being put in. There's only 3 more than 1 standard deviation move put in by the S&P, for example, though one of those was a 2 standard deviation move. So nothing really to get excited about there. Something that is a warning, skew came in over 135 for yesterday, so that is a warning of the higher probabilities of a multi-standard deviation move. And indeed, when you look at being down some 16 points in the overnight. We could have a professional gap down. We have an hour and a half yet from the time of this recording until the market opens, but so that could change. We could see that start to fade and fill that gap, but right now it's a big professional down gap, and certainly the skew would tell us that that is quite possible to have a very weak day today. In terms of short-term VIX, 22.46. This had edged down below 20, but is now popped back up and is running fairly hot again. So kind of keep that in mind as well. In terms of our regular daily report, not a lot of changes from yesterday, but some. And these things tend to be incremental. But we're still phase 2, trend breaking, still looking for this situation where the most recent setups are lower lows and lower highs. In terms of the overall portfolio investor posture, IBD status uptrend under pressure. The accumulation distribution score for the S&P is a D-, NASDAQ an E. GMI index is a 0 out of 6 with a sell signal since 824, and that author remains in cash. Primary market condition remains strong bear. On stock charts, you have a vast preponderance across all time frames and all markets of down arrows. When you put the consensus of all these signals together, portfolio investor posture is decidedly bearish. When you look at the intermediate term, that market posture is very bearish. After having spent a number of days in the weak bull category, it has flipped over, and the S&P, you see 38.5, very bearish. Also Dow now also very bearish at a 47.1. Russell also very bearish, 42.7. Only NASDAQ is holding up with a little bit of a weaker kind of situation in the terms of how strong the bear is. It's at a 62.0. Overall position sizing opinion right now from the portfolio metric, position size can be up to 50%, and then from the volatility base, that's also suggesting a 50 to 75% position size. So another reason to be relatively cautious at this time. Overall hedge warning status is currently a threshold level 2, the red light level, and again this says that risk is elevated, and while this is not a prediction that the market will move down or a prediction of how far it will move down, it is saying that the risk level is clearly elevated to a point that you should consider being very, very careful about the initiation of any new positions, especially for novice traders in the bullish direction. In terms of the individual components, volatility, we do have a market in decline and sharp increase warnings present. VIX up over 18. Distribution day count did not increase yesterday, but we do still remain with a 4. Very quick arrival at the level of 4 with the S&P and the NASDAQ. This count, once reset and started, has hit these levels very quickly. So those are certainly warnings in themselves. If this hits a 5, that becomes a full-out warning on that metric. VIX phase has been increasing. Skew, as I mentioned, is up over 135. Also, the New York Stock Exchange, new highs, new lows, right at 300. So a lot more new lows than new highs yesterday, even on a relatively narrow range, low volume day. A lot more new lows being put in. In terms of the intermarket risk aversion indicators, we have 4 that are flat out risk off, and the only one that was risk on is clearly rolling over. So again, more warnings. In terms of special opinions, option income strategies, VIX is outside the acceptable window for the initiation of new option income strategies for novice traders. More experienced traders, of course, may want to take advantage of this elevated premium, but just know that along with that, when you have these kinds of conditions, you could have large delta moves and large vega moves that could create circumstances for a lot more adjustments and need to potentially add capital and being able to play those trades out to a satisfactory conclusion. In terms of covered call strategies and put selling, in both of these were kind of similar situation. Conditions are borderline acceptable for new positions for novice traders, but in those cases you'd want to have reduced positions and use very conservative type of entries. For example, covered calls, consider legging into those covered calls through put selling and allowing yourself, if necessary, to be assigned and then convert to the covered call strategy. Consider scaling into the position size, and certainly when you do sell those puts, use a defined risk spread to kind of limit the exposure that you might have. Very difficult conditions, really, and we say really borderline acceptable, really truly borderline acceptable for novice traders to be either put selling or covered call strategies at this time. We've only been nibbling at these things in the current market conditions ourselves. In terms of sector specific, we continue to see a sea of red across all 9 sectors, across all time frames. Only utilities has been holding up with any kind of consistency. And of course, keep in mind that while the interest rates were delayed, when those interest rates do increase, and that could be literally, next month or in December, utilities will likely take a hit. So utilities has shown some relative strength, and you look at the 1-year time frame, but at the same time, this certainly when they thought earlier in this year, in 2015, that interest rates were going to start to unravel, utilities took a pretty steep pullback, and you see this reflected in the year-to-date performance. So don't think that just simply going to utilities is your answer, without taking into account that those interest rates are looming out there, and that will hurt utilities and other interest rate sectors. In terms of the one-day performance, you see there was some positive yesterday, but pretty much mixed. You see materials and energy, though, well down. And then, of course, in context, 5-day, 1-month, 3-month, year-to-date, a sea of red here. So continue to keep perspective on just what kind of market conditions you're currently trading in. And that should be enough for today. As always, as you find that these suggestions and opinions and insights are helpful to your trading, we appreciate in return that you retweet us to your Twitter followers, your StockTwit followers, you like us on the YouTube channel or subscribe to us on the YouTube channel. If you have direct feedback, you can send that to support@falconglobaltraders.com. That's the email address. More information about what we do and how we actually apply these principles to our daily trading can be found at this website. Free trials are certainly available. Disclaimers, as always, hit the pause button if you need more time to review this. And we will certainly look forward to being back tomorrow morning before the market opens with the Falcon Global Market Preview. Good trading to all.